We're looking at an analysis of APLD stock, which dives into its 84% year-over-year revenue jump and its massive contract backlog versus rising debt. Let's get straight into the feedback. Okay, so let's start with that headline number, that huge 84% revenue spike. Clarifying the operational pivot from construction-related tenant fit-out services revenue to sustained recurring hosting income is, I think, crucial for accurately assessing APLD's future valuation stability.
Yeah, that's a really sharp topic sentence. And look, the analysis report does a great job of isolating that $26.3 million figure.
It does.
The identification of that specific revenue stream, the fit-out services for Polaris Forge 1, is nailed perfectly. That transparency is excellent, but it also confirms that a huge chunk of that 84% jump was, a one-time thing.
Right. So the engine is changing its fuel source, basically.
Exactly. And that's where the weakness is. The material, it clearly identifies the $26.3 million as the one-time driver, but it sort of stops there. It doesn't quantify the timeline or the immediate stability of the switch to recurring hosting revenue.
That phrase, later this year.
Mm-hmm.
It's just too vague, isn't it? For a high-growth stock where the entire market is watching execution timelines, that's not enough.
It's really not. And I agree completely. That vagueness, it just introduces uncertainty where you don't need it, especially when you have this very strong bull case built on an $11 billion backlog.
So what's the suggestion? How do you fix that?
The analysis needs to project the magnitude and the velocity of the recurring revenue ramp-up. You have to benchmark it against this big one-time gain. That's how you strengthen the strong buy argument. You have to show the math on the transition.
Okay, but modeling that ARR ramp-up sounds, challenging. You're talking about projecting construction timelines, which can be pretty variable. How can the report make that concrete for a reader?
You use the $26.3 million figure itself as the baseline. It becomes your yardstick.
Okay.
First, you compare that one-time revenue against the estimated ARR, the annualized recurring revenue, that's expected from the CoreWeave agreement once Polaris Forge 1 is fully online.
I see.
So, hypothetically, if the ARR is projected to be, say, 5 or 6 times that number, showing that magnitude right away, it just legitimizes the whole long-term thesis.
It shifts the reader's focus from fear of a drop-off to anticipation of what's coming next.
Exactly. It stops being a vague promise. And second, get aggressive with the modeling. You suggest a scenario where that fit-out services revenue just stops immediately.
Okay, a stress test.
Right. The report says the current quarterly revenue run rate is $64.2 million. So you calculate the quarterly growth rate in recurring revenue that you need just to maintain that $64.2 million.
So it gives you a hard target.
It gives you a hard target. It provides these clear, trackable milestones. It turns that vague promise into an operational target that says, look, we need 15% sequential growth just to stay flat. That's an actionable measurement.
Yeah, that's a critical change. It really forces the reader to focus on those deployment milestones. That's a solid fix for the top line. Okay, let's pivot from revenue to the capital structure. The debt. The analysis flags it, but I think we need to integrate that risk more structurally. So the next point is this. The presentation of the $2.35 billion debt offering must be integrated more aggressively into the bear case to reflect the true leverage risk.
And to be fair, the analysis makes a strong case for APLD as an AI infrastructure play. And that kind of business, it requires huge upfront capital spending.
Of course.
So it rightly points out the $2.35 billion debt as a liquidity boost in the bull case. It prevents dilution, it funds construction. That framing isn't wrong.
But here's the problem. The existing risks to watch section, it feels like it's focused on the wrong things. It's all market sentiment.
Mm-hmm.
It highlights short interest, which we'll get to, and this marginal insider selling. The director, Ella Benson, sold $199K worth of stock. Frankly, for a company with an $11 billion contract, that's just noise.
It's a rounding error. It pales in comparison to the fundamental risk from a $2.35 billion secured debt load. Why waste time on the noise when the real risk is structural?
Exactly.
Because in these capital-intensive infrastructure plays, the balance sheet is the risk. You've got a company posting net losses, that 0.03 adjusted EPS loss, and it's leveraging its future to build its present.
The chatter about insider selling is completely irrelevant next to the hard financials.
It is. So the risk analysis needs to address the cost of that capital, the future debt servicing requirements for that $2.35 billion. You have to ground the profitability risk in hard financial leverage, not market gossip.
Right now, the debt is mostly treated as just, free capital for building things, not as a major future obligation that's going to hit the P&L immediately.
Immediately. So let's make this actionable. The analysis gives us the $64.2 million quarterly revenue figure.
Right.
So, include a brief analysis of how the debt service obligations might impact the timeline to profitability. Specifically, you calculate what percentage of that quarterly revenue might hypothetically be consumed by interest payments.
So readers can see the drag factor.
They need to see the drag factor. If, say, 10% of their current revenue is going straight to interest, that immediately clarifies the profitability challenge. It's not some far-off problem, it's right now.
That definitely transforms the debt from an abstract number into an immediate operational constraint.
And to really elevate it, you have to focus on the phrase secured notes. What does secured actually mean here?
It means it has priority. It's backed by assets.
It's backed by the very assets they're building, the data centers, the servers. So you should propose focusing on the rigidity this creates. How does this debt's priority limit their future financial flexibility if that $11 billion pipeline sees any delays?
So if they needed cash and wanted to sell some assets,
The senior secured note holders get paid first. This raises the discussion beyond simple dollar figures and into structural rigidity. That's what sophisticated readers are looking for.
that is a key distinction. It's not just that they have debt, it's that the debt could handcuff the very assets meant to drive future revenue. That needs to be front and center in the bear case. Okay, moving on to our final key area, the short interest. The material notes about a third of the float is sold short. That is a massive number, and it signals some serious skepticism. Our final critique is that the analysis has a unique opportunity to connect that high short interest directly to specific contractual milestones. It can transform a standard observation into a really powerful operational thesis.
Yeah, that's laid out very clearly. The observation itself, that 33% of the float, about 79 million shares, is shorted. That's an incredibly powerful data point.
It is.
And, mentioning the possibility of a short squeeze it's conventional. But for this level of analysis, I feel like it's a wasted opportunity.
That's the weakness right there. For a report on a build and deploy model, the connection between the short position and the specific execution risks is underdeveloped. The shorts aren't just betting on bad luck.
No, they are betting on a failure to execute. A failure to execute the core we've built out on time and on budget and to hit that profitability timeline.
So the analysis needs to reflect that specificity.
It has to. You need to anchor the short interest thesis directly to that contracted revenue pipeline. The analysis should identify the specific operational event that would act as the definitive catalyst, the thing that would force shorts to cover immediately because success is confirmed.
But doesn't the market already do that? I mean, if they announce Polaris Forge 1 is complete, won't that trigger a squeeze anyway?
Not necessarily, because completion can be subjective.
Okay.
The people shorting this are sophisticated. They're betting on the difference between infrastructure in development and infrastructure actively generating revenue. A completed building doesn't mean the racks are full, the GPUs are running, and the cash is flowing.
So we need a quantifiable, non-subjective metric, not just general good news.
Precisely. You define the operational trigger that validates the entire business model. The moment that execution risk shifts to realization certainty.
Okay, that's a crucial distinction. Development versus active revenue generation. How do we make that trigger quantifiable for the short thesis?
You propose focusing the short squeeze trigger on a measurable metric, something tied to operational capacity. For instance, the analysis could suggest that the market should be watching for the announcement that a specific percentage, say 50% or 75% of the contracted capacity, has gone fully live and operational.
So it's a clear, unambiguous checkpoint.
It's an unambiguous checkpoint that proves the execution risk is fading fast. This moves the trigger from a vague, a short squeeze is possible, to an actionable, when this metric hits, the squeeze is imminent. That's what makes the analysis so much more valuable.
So by tying the short thesis to the deployment of the $11 billion backlog with a quantifiable metric, it moves from just commentary into an informed projection based on actual execution. That's a huge upgrade. This has been a very focused critique of the APLD analysis. I think we've covered 3 major opportunities to strengthen this piece, all centered on better quantification and deeper structural analysis.
Yeah, the main takeaways are clear. First, quantify that transition risk. Move from the one-time revenue to recurring and use the $26.3 million gain as the baseline to model the ARR ramp-up you need.
Second, Deepen the risk analysis of that $2.35 billion in debt. Calculate its impact on the current revenue run rate and really dig into the constraints imposed by those secured notes.
And finally, link the high short interest to a specific operational catalyst. Don't just talk about a squeeze. Define the trigger. Use a quantifiable metric, like percentage of facility activation from that $11 billion backlog.
Implement these suggestions to maximize the reader's experience and the overall impact of the piece. We invite you to implement these suggestions and submit the revised analysis report back in